Imagine discovering money you've already earned,
Hmm.
money that the tax man simply isn't interested in,
Hmm.
or finding perfectly legitimate ways to keep more of what you make just by, understanding a few key rules.
You're right.
It's not magic. It's really about knowing where to look in this, well, intricate world of gross income and maybe more importantly, those powerful tax-saving exclusions.
What's truly compelling here, I think, is how many everyday transactions, common employer benefits, even investment strategies, can be structured to your significant tax advantage.
hmm
A lot of individuals are, frankly, leaving substantial savings on the table simply because they're maybe unaware of the specific provisions designed to benefit them.
Absolutely. So today, our mission is really to cut through all that complexity.
Certainly.
We're going to extract the most important nuggets of knowledge, some surprising facts about what isn't taxable, and then, crucially, show you how you can maybe apply these insights to your own financial picture. Think of this as your personal shortcut, maybe, to being well-informed on actively reducing your tax burden. But before we jump into, the exciting world of tax savings, we probably need to establish a quick but fundamental understanding of what we're even talking about when we say gross income
Right.
and why that initial definition is so critical to our entire discussion today.
You've hit on a crucial starting point there. The Internal Revenue Code, well, it casts an incredibly wide net when it comes to defining gross income. Generally, it means all income from whatever source derived, unless specifically excluded. And that last part, unless specifically excluded, that's paramount.
Okay.
It basically means that pretty much anything that increases your wealth is considered income, unless there's a very specific, explicit exception carved out in the tax law.
So it's not just your regular paycheck, right?
Yeah.
The definition sounds incredibly broad.
It is.
Like even if you were to, say, find $4,000 in cash hidden under a floorboard in your house.
Right, the classic example.
And you genuinely couldn't find the original owner, if you keep it, that $4,000 actually increases your economic well-being. So because of that broad definition, it's considered taxable income, even though you didn't, earn it traditionally.
Exactly. That's precisely it. And it's not limited to cash either. If you perform services for someone and, receive property in return, maybe a car with a fair market value of $3,000 as compensation. That $3,000 fair market value is also considered income. This broad sweep of the tax net highlights a critical point. If the general rule is everything is income, then our deep dive today really focuses on those vital exceptions.
Few exclusions.
Exactly, the specific rules that allow you to legitimately keep more of your hard-earned money.
That makes perfect sense. Okay, now let's turn our attention to a concept that's absolutely fundamental to understanding when income actually becomes taxable.
Okay.
The difference between realization and recognition. It might sound a bit technical, but for your personal financial planning, this distinction is, well, incredibly powerful.
It truly is a key concept. For a gain to actually be taxable, it has to meet both conditions. It must be realized and recognized.
Okay, realization first. What's that mean?
Realization essentially means there's been an actual transaction or event, where you've accrued or received cash, property, or services.
Okay.
It could also mean a change in the form of your investment, like a sale or an exchange. Something definite has happened.
So for example, if you own a stock that you originally bought for, say, $100, and over time its market value goes up to $150.
Right.
That $50 increase in value, that potential gain, isn't realized yet because you haven't actually done anything to capture it. It's just a paper gain.
You've got it. Exactly. You haven't realized that gain until you actually sell those shares for $150 or maybe exchange them for other property.
Ah, okay.
Only then has the wealth been sort of converted into a tangible form you can act on.
And that leads us to the second part, recognition.
Precisely. Recognition means that the realized gain must actually be included on your tax return.
Oh.
And this is where those crucial tax exclusions we're talking about come into play. There might be a specific provision in the Internal Revenue Code that permits an exclusion or maybe a deferral, meaning that even though the gain is realized, it's not recognized as taxable income in that particular period.
Got it.
So it's a vital distinction. Just because your assets increase in value doesn't mean you owe tax yet. It's all about when that gain is actually realized and recognized, and critically, whether there's a specific rule that says you don't have to report it right now or ever.
That's a powerful distinction for listeners to grasp, really understanding that timing and those specific exceptions is truly where the real tax savings opportunities emerge. Okay, now that we've set the stage for what is generally considered income, let's dive into the core of our discussion. All those incredible ways the tax code allows you to keep more of your hard-earned money, particularly through, employer-provided perks and benefits. Let's talk about the bedrock of most people's income,
Yeah.
salaries and wages. Now, while much of our direct compensation is clearly taxable, here's where it gets truly fascinating.
Hmm.
There are some remarkable hidden benefits and compensation structures that can significantly benefit your bottom line by reducing your taxable income.
That's spot on. And it's important to first acknowledge what is generally included, right?
Mhm.
Your direct salary or wage payments, obviously.
Right.
The fair market value of any property you receive is compensation, even those bargain purchases where your employer sells you something for less than its fair market value.
Yep.
That difference is typically considered income.
Okay.
For partners in a business, specific guaranteed payments are also income and, importantly, subject to self-employment tax. And then there are certain fringe benefits that are taxable,
Such as?
like the personal use of a company car maybe, or employer contributions to a Roth 401k account. Those usually show up right on your W-2.
Uh-huh.
Even portions of employer-paid life insurance premiums, specifically for coverage above $50,000, can be taxable income, calculated based on specific IRS tables.
But the real power, it seems, lies in the specific exclusions the tax code carves out for many other employer-provided perks.
Absolutely.
These are essentially valuable benefits from your employer that the IRS often doesn't consider part of your taxable income.
Couldn't agree more. Let's delve into these non-taxable fringe benefits because they really represent significant, often overlooked value. First up, life insurance coverage.
Oh.
Employees can exclude from their income the value of employer-paid group-term life insurance premiums for up to $50,000 of coverage.
So if my employer provides that, I don't pay tax on the value of that premium.
Correct. It's a direct tax-free perk.
Uh-huh.
Now, for any coverage above $50,000, there is a taxable amount, but it's only calculated on the cost of that excess, using those IRS tables I mentioned, which is often far less than what you might pay for similar coverage on your own. So yeah, if your employer offers this, you're already enjoying a powerful tax-free benefit.
That's a great one. And for many of us, I imagine even bigger are the accident, medical, and health insurance benefits that our employers provide.
Absolutely vital. Employer-paid premiums for accident, medical, and health insurance are completely excludable from your income.
Wow.
This is a massive benefit for most employees. Your employer is covering a significant expense, maybe thousands of dollars, and you're not taxed on the value of those premiums at all.
Okay, but what about payments from the policy if I get sick and the insurance pays out?
Good question. It's important to remember that while the premiums are tax-free to you, payments from the policy are generally includable in income. Unless, and this is key, unless they specifically reimburse medical expenses you actually incurred or they compensate you for the permanent loss of a body function.
Got it. So reimbursement for actual costs or specific loss compensation is okay.
Generally, yes.
Then we have those delightful little things that are essentially too small to count, what the tax code calls de minimis fringe benefits.
Yes, these are benefits so minimal in value that accounting for them would just be impractical, so they can be excluded from income.
Like a what? The occasional personal copy on the office machine?
Exactly. Or, personal use of company computer sometimes. Maybe coffee and snacks provided in the office, or even holiday parties.
Yeah.
It's truly a charming little tax-free bonus for everyday conveniences.
Nice. What about when your job actually requires you to live or eat at your workplace?
Right. The value of meals and lodging furnished in kind by an employer can also be excluded, but only under very specific and pretty strict conditions.
Okay, what are they?
It must be for the convenience of the employer, furnished on the employer's business premises, and crucially, for lodging, it must be required as a condition of employment.
So you have to live there to do the job properly.
Essentially, yes. Think of maybe a hospital resident on call who has to stay in a room at the hospital, or perhaps a hotel manager who lives on site as an essential part of their duties. Those specific scenarios can qualify for this exclusion.
Okay. Now, here's a huge opportunity for anyone looking to advance their career or maybe even reduce existing student debt, employer payment of employees' educational expenses.
This truly is a game changer if your employer offers tuition assistance or student loan help. Up to a significant amount, you'll want to check the current IRS guidelines for the precise annual limit, but it's often over $5,000.
Wow.
May be excluded from your gross income for employer payments towards educational expenses and into qualified student loans. And this applies to both undergraduate and graduate level education.
So that $5,000 plus just goes straight to the school or lender and it's not counted as income for me.
Exactly. That amount goes directly into your pocket, so to speak, without
Mm,
being taxed. It represents a direct saving on what would otherwise be a substantial personal cost.
that's massive. And for those expanding their families, there's also crucial support through employee adoption assistance programs.
Yes, another really significant benefit. A substantial amount of qualified adoption expenses paid by an employer can be excluded from taxable income. Again, you'd refer to the current year limits, but it's a generous figure, often well over $10,000.
Is there an income limit?
Yes, this exclusion does typically phase out for higher income taxpayers. But for those who qualify, it's a truly meaningful tax-free benefit for a very significant life event for a family.
Another powerful one, particularly for working parents, is dependent care assistance.
Absolutely. Employees can exclude up to a specific annual limit, currently around $5,000 of employer-paid or reimbursed dependent care expenses from their gross income.
And that covers childcare.
Yes, it directly applies to the cost of childcare for children under a certain age, usually 13, or for the care of a physically or mentally incapable spouse or dependent. It's a direct way to reduce your out-of-pocket costs using pre-tax dollars.
For those working in academia, there seems to be a specific benefit related to qualified tuition reduction.
That's right. Employees of educational institutions studying at the undergraduate level can typically exclude tuition reductions from their income.
And grad students.
Graduate students can also exclude tuition reduction, but there's a condition. Only if they are engaged in teaching or research activities. And the reduction is in addition to their regular pay for that teaching or research.
Ah, okay.
And for any of these reductions to be excludable, they generally must be offered on a non-discriminatory basis to all eligible employees. It's definitely a major perk for those tied to educational institutions.
And who doesn't love a good employee discount? Turns out, a good chunk of that can often be tax-free.
That's right. Qualified employee discounts are excludable, but there are specific limits you need to know about.
Okay.
For merchandise, the excludable discount is limited to the employer's gross profit percentage. If the discount you get is greater than that, the excess amount is actually taxable income.
And for services.
For services, the excludable discount is limited to 20% of the fair market value of the services offered to regular customers. Any discount beyond that 20% is considered taxable income.
So those generous employee discounts often, a significant portion of that saving you receive is completely tax-free.
Exactly. It pays to know the limits.
This next one is surprisingly useful for many daily commuters. Employer-provided parking and transit passes.
Indeed. For the current tax year, employees can exclude up to a certain monthly limit for employer-provided parking, and there's a separate monthly limit for transit passes. Check the current year amounts, they adjust for inflation. What's particularly powerful here is that this exclusion applies even if you, the employee, choose to take the parking or transit benefit instead of taxable cash compensation, like a salary reduction.
Oh, interesting. So you could choose the pass over cash and save on taxes.
Potentially, yes. This highlights a key planning opportunity. Are you maximizing these pre-tax benefits if your employer offers them? Opting for a transit pass instead of the equivalent amount in cash might save you hundreds, maybe even thousands, in taxes annually simply by utilizing a benefit that avoids income tax altogether.
Good point. And then, of course, the cornerstone of long-term financial planning.
Yeah.
Qualified, non-Roth retirement plans.
Right, things like your traditional 401k or maybe a 403b. Employer contributions to these plans are generally not considered income to you, the employee, at the time the contribution is made.
In my own contributions.
Similarly, you can usually elect to contribute a portion of your salary pre-tax, which directly reduces your current taxable income.
That's the big advantage, isn't it? The tax deferral.
It's immense. You don't pay tax on the money going in, nor on the earnings it generates year after year, until those benefits are actually distributed, usually in retirement.
Right, then it's taxed.
At that point, the distributions are typically taxable as ordinary income. But it's a foundational element of tax-deferred savings, allowing your money to grow largely unburdened by annual taxes for potentially decades.
Okay, finally, within employer benefits, we have flexible spending arrangements, or FSAs. What are those exactly?
FSAs, typically offered under what's called a Section 125 plan, allow employees to get pre-tax reimbursement for certain incurred expenses. Most commonly, we see these for healthcare and/or dependent care costs.
So how does the pre-tax part work?
Employees can elect to have a portion of their salary, up to an annual limit set by the IRS, deposited pre-tax into an FSA. These deposits are made via salary reduction, meaning you're not taxed on that income when it goes into the account.
And then I use that money for, say, doctor copays or daycare.
Exactly. This is a powerful tool for those predictable health or dependent care costs, letting you pay with pre-tax dollars, significantly reducing your actual out-of-pocket burden.
But there's a catch, right? The use it or lose it thing.
Yes, that's crucial. Generally, funds not used within the plan year, or sometimes within a permissible grace period if your employer's plan allows it, are forfeited.
Ouch.
Some plans do allow a limited carryover, maybe around $600 or so, to the next year. But it's absolutely vital to understand your specific plan's rules, the deadlines, whether there's a grace period or carryover, to avoid losing that money you set aside.
Definitely. So you see, your employment can truly be a goldmine of tax-free advantages. Careful structuring by employers and your understanding of these benefits can significantly cut your taxable income.
It really can.
But the tax-saving opportunities don't stop there. Let's shift gears now to how your investments and other income streams can also be structured to save you money.
Okay. We often think of interest income as just straightforwardly taxable, and, most forms are.
Like what?
Well, for instance, interest from federal government bonds,
Yeah.
corporate bonds, most industrial development bonds, even the interest the government pays you if they're late with a tax refund. Those are all generally taxable.
Okay, that makes sense. But here's where it gets interesting. There are specific types of interest income that are completely tax exempt. This feels like a critical area for making smart investment choices.
It absolutely is. The primary and probably most common example is interest on state and local government bonds or obligations, often just called municipal bonds or munis.
Right.
This interest is tax exempt at the federal level, and frequently it's tax exempt at the state level too if you happen to live in the state that issued the bond.
And that applies to mutual funds holding those bonds, too.
Yes, this exclusion also extends to the dividends you receive from mutual funds that are primarily invested in these tax-free bonds.
Good to know. Any others?
Beyond that, interest from U.S. possession bonds, like those issued by Puerto Rico or Guam, is also typically tax-exempt.
Okay. And for families diligently saving for future education expenses, there's a powerful exclusion related to U.S. Series E savings bonds. Tell us about that.
Yes, interest on U.S. Series E savings bonds issued after 1989 can be tax-exempt, but, and this is important with very specific conditions,
Okay, what are the hoops?
it's tax-exempt if the proceeds are used to pay for qualified higher education expenses for the taxpayer, their spouse, or their dependents. Some important stipulations include that the taxpayer must be over age 24 when the bond is actually issued. Married taxpayers have to file a joint return to claim the exclusion, and there are income-based phase-outs that apply. The income limits change, so you have to check each year.
And ownership matters too, right?
Critically, if you're using these bonds to pay for a child's education, the bonds must be registered in the tax holder's name and or their spouse's name. The child can be listed as a beneficiary, but not as a co-owner.
Okay, so lots of rules, but potentially very valuable.
It's a fantastic way to save for future education expenses while potentially enjoying tax-free growth. But absolutely remember to check those specific income and ownership criteria. They're crucial for actually getting the exclusion.
Makes sense. Now, what about those situations where you maybe incur a penalty for withdrawing money early from a savings account, like a certificate of deposit, a CD? You still earn some interest, but then a chunk is forfeited. How does that work tax-wise?
Right, that's called forfeited interest, and the tax code provides a specific adjustment for it.
Okay.
While the interest credited to your account during the year is initially considered taxable income, the amount the bank removes as a penalty for that early withdrawal is deductible. It's an adjustment to your income in the year the penalty is incurred.
So I only pay tax on the net amount I actually kept.
Effectively, yes. You
Yeah.
only pay tax on the net interest you actually received after the penalty. It's important to note, though, this forfeited amount is deducted separately on your tax return, usually on Schedule 1. It's not just directly netted against your interest income by the bank on the 1099 INT form.
Good clarification. Okay, shifting to dividend income, it seems straightforward, but you mentioned earlier, not all dividends are created equal for tax purposes.
They are most certainly not. Dividends that come from corporate earnings are generally taxable. However, a significant tax-saving opportunity lies with what are called qualified dividends.
Okay, what makes them qualified?
These are dividends paid by domestic corporations or certain qualified foreign corporations. And critically, they receive preferential long-term capital gains tax rates.
Which are lower than regular income tax rates, right?
Much lower for most people. This can mean a 0%, 15%, or 20% tax rate, depending entirely on your overall taxable income level.
Is there a catch, like a holding period?
Yes, there is. To qualify for these significantly lower rates, the stock generally needs to be held for a sufficient period around the dividend payment date specifically. More than 60 days during a 120-day period that begins 60 days before the ex-dividend date.
The ex-dividend date, that's the date you have to own the stock by to get the dividend.
Sort of. It's the first day the stock trades without the right to the upcoming dividend. So you need to hold it for a period including that date.
Okay. And if you don't meet that holding period, or if the dividend comes from certain types of entities, it's considered non-qualified.
Exactly. Non-qualified dividends include those from, say, employer stock held by an employee stock ownership plan,
Mm-hmm.
an ESOP, amounts taken into account as investment income, dividends related to short sale positions, certain foreign corporations that don't meet specific criteria, and dividends paid by credit unions, mutual savings banks, and similar entities. They just get taxed at your ordinary income rate.
So understanding this difference between qualified and non-qualified dividends is really key to optimizing your investment income and potentially saving significantly on taxes.
Absolutely. It's a critical element for smart investment planning and tax management.
Now, for even more savings,
Yeah.
you mentioned certain distributions that might look like dividends but are actually tax-free distributions. Tell me more.
Yes. First, probably the most common is a return of capital.
Okay.
This happens when a C corporation distributes funds to shareholders, but it has no current or accumulated earnings and profits to pay dividends from.
So where's the money coming from?
Essentially, it's considered a non-taxable return of your original investment. It's not treated as income. Instead, it simply reduces your cost basis in the stock.
So I'm not getting taxed on it because I'm just receiving back part of what I originally put in?
Precisely. You're effectively just getting your original investment dollars back, not new income, so it's not subject to tax at that moment. It will affect your gain or loss later when you sell the stock, though, because your basis is lower.
Makes sense. Then there's a stock split. That seems pretty common.
Right, and a stock split is also a non-taxable event. When a stock splits, say 2-for-1, you simply reallocate your original cost basis over the total number of shares you hold after the split.
So if I had 100 shares with the basis of $10 each, total $1,000 basis, after a 2-for-1 split, I have 200 shares.
Exactly. And your basis per share becomes $5. Your total $1,000 basis remains the same. It's just divided differently among more shares. No tax consequence at the time of the split.
And what about a typical stock dividend, where they give you more shares instead of cash?
Generally, a stock dividend is also non-taxable. The main exception is if you, as the shareholder, have the option to receive cash or other property instead of the stock.
Ah, if there's a choice.
Right. If you have that choice and you opt for the stock, then it becomes taxable at its fair market value. But otherwise, if you only have the option for stock, it's generally non-taxable, and like a split, you just reallocate your original basis across the total shares held after the dividend.
Okay, and one more?
Finally, life insurance dividends from mutual insurance companies. These are often considered a return of the premiums you've paid, so they are also generally excluded from gross income.
Got it. Okay, beyond the sort of traditional income streams and investments we've discussed, certain life events and major financial decisions can also trigger unexpected and sometimes significant tax benefits. Let's explore those.
A common one, definitely, and a source of frequent misunderstanding is state and local tax refunds.
Ah, yes. Do I have to pay tax on that state refund check?
It depends. A state or local income tax refund you receive in a subsequent year is not taxable if the taxes you paid in that prior year did not actually result in a tax benefit on your federal return.
How would that happen?
This typically happens if you use the standard deduction on your federal return in the prior year instead of itemizing your deductions.
So if I took the standard deduction last year, which many people do now, and then I got a state tax refund this year, that refund isn't taxable.
That's spot on, generally. Let's take an example. Carlos is single. He used the standard deduction on his year 10 federal return. In year 11, he gets a $150 state income tax refund from year 10.
Okay.
That $150 refund is not includable in his year 11 income. Why? Because he didn't itemize in year 10, so he didn't get a federal tax benefit from paying those state income taxes in the first place.
That's a common misconception cleared up. If you didn't itemize and took the standard deduction, that refund check is usually pure profit for you, completely tax-free.
That's usually the case, yes.
That's a great example of a hidden tax saving. Now let's talk about something that impacts many lives. payments pursuant to a divorce. The tax rules here have changed dramatically in recent years, haven't they? Making the date of the agreement incredibly important.
This is a critical area, absolutely. And the execution date of the divorce or separation agreement is truly paramount. It dictates the tax treatment.
How so?
Okay, for agreements executed on or before December 31st, 2018, the old rules apply. Alimony or spousal support payments are includable in gross income by the person receiving them, and they are deductible by the person paying them.
Okay, the old way. What changed?
For agreements executed after December 31st, 2018, the rules flipped completely. Alimony received is not included in gross income by the recipient,
Oh, wow.
and consequently, alimony paid cannot be deducted by the payer.
So it's tax-free to the recipient, but not deductible for the payer if the agreement is recent.
Exactly.
Yeah.
This shift dramatically impacts the taxability and often the negotiation for both parties. So always check the execution date of the agreement.
That's a huge shift. So if your agreement was entered into after 2018, receiving alimony isn't a taxable event for you. What about child support? Did that change too?
No, child support is always clear-cut and hasn't changed. It's always non-taxable to the recipient and always non-deductible by the payer.
Okay. And what if someone is supposed to pay both alimony and child support, but they don't pay the full amount?
Good question. There's an allocation rule. If payments fall short for both obligations, the payments received are allocated first to child support until that obligation is fully met. Only then is any remaining payment applied to alimony.
So the kids come first tax-wise too.
Essentially, yes. It ensures the child support is prioritized in the eyes of the tax law.
And property settlements, like dividing up assets.
Similarly, lump sum payments or property settlements in a divorce are generally non-taxable to the recipient and non-deductible by the payer. These are typically seen as divisions of existing marital assets, not as income generation.
Okay. Next up, a really big one for retirement planning and a crucial area for tax strategies: IRA distributions.
Yes, individual retirement arrangements. Distributions from IRAs consist of two potential components: the principal, your contributions, and the earnings. The tax treatment depends very heavily on whether it's a traditional IRA or a Roth IRA.
And how are the taxable parts taxed?
Any taxable distributions from either type of IRA are always taxed as ordinary income. It doesn't matter if the growth came from capital gains within the account. When it comes out taxable, it's ordinary income.
Okay, so let's start with traditional IRAs. How are those taxed when you take money out?
For traditional IRAs, if you took a tax deduction for your contributions when you made them, which most people do, then any distributions of that principal, those deducted contributions, are taxable when they come out.
And the earnings?
Distributions of earnings from a traditional IRA are always taxable,
Oh.
regardless of whether you deducted the original contribution or not.
What if I made contributions I didn't deduct? Sometimes that happens if your income is too high to deduct.
Right. If you contributed to a non-deductible traditional IRA, then distributions are prorated. Part of each distribution is considered a tax-free return of your non-deductible principal, and the other part is considered taxable earnings. You have to keep track of your non-deductible basis using Form 8606.
Sounds complicated.
It requires good record keeping, definitely. And don't forget, for traditional IRAs, there are required minimum distributions, or RMDs, which generally must begin by April 1 of the year after you turn age 73.
Okay, now here's where it gets genuinely powerful. For tax savings, you hear this all the time. Roth IRAs are a tax-saving powerhouse. Why?
They truly are, primarily because of how distributions are treated. First, distributions of your original contributions from a Roth IRA are never taxable.
Why not?
Because you already paid tax on those contributions going in. They weren't deductible, so you're just getting your own after-tax money back.
Okay, that makes sense. What about the earnings? That's where the growth is.
The real magic happens with qualified distributions of earnings. Earnings withdrawn from a Roth IRA are only taxable if the distribution is non-qualified.
So what makes a distribution qualified and therefore tax-free?
Two conditions must be met for a distribution of earnings to be qualified and tax-free. First, it must be made at least 5 years after the first day of the year you made your very first contribution to any Roth IRA. There's a 5-year clock that starts ticking.
Okay, 5 years. And the second condition?
Second, the distribution must meet one of these additional requirements. Either the taxpayer is age 59 and a half or older, or the taxpayer is disabled, or it's used for a first-time home purchase, up to a lifetime maximum, currently $10,000, or it's made to a beneficiary after the taxpayer's death.
So meet the 5-year rule, Andy, one of those life events, and the earnings are tax-free.
Correct. Both principal and earnings come out completely tax-free.
And the order of distribution matters when you take money out of a Roth, right? Which money comes out first?
Yes, that's a critical your principal, your contributions, which is always non-taxable. Only after you've withdrawn all of your contributions or subsequent withdrawals considered to be earnings.
Let's walk through an example. Say Sally opened a Roth IRA when she was 55, put in $5,000. A few years later, the account's worth $8,000, so $3,000 in earnings. She withdraws $6,000 for a trip. What happens?
Okay, it depends if it's qualified or not. Let's say this happens only 4 years after her first contribution. The 5-year rule isn't met, so it's a non-qualified distribution.
Right.
She withdraws $6,000. The first $5,000 is considered return of her principal, totally non-taxable.
Okay.
The remaining $1,000 of the withdrawal is considered earnings. Since it's a non-qualified distribution, that $1,000 of earnings is taxable as ordinary income and potentially subject to a 10% penalty if she's under 59.5 and no exception applies.
Ouch. But what if she had just waited a couple more years, say 6 years after her first contribution, making her 61?
Big difference. Now, both the 5-year rule and the age 59.5 rule are met. It's a qualified distribution.
So the whole $6,000.
The entire $6,000 distribution, both the $5,000 principal and the $1,000 earnings, would be completely non-taxable. No tax, no penalty.
Wow. Imagine all those years of growth, totally untouched by tax. That really shows the power of the Roth, especially if you meet those qualified distribution rules.
Absolutely. It's designed for truly tax-free retirement income if used as intended.
Now, what if you need to access your IRA money, traditional or Roth earnings, early, before 59.5? There's typically that 10% penalty tax, right? But it's important to know there are crucial exceptions.
That's right. Generally, premature distributions before age 59.5 incur that 10% penalty tax in addition to any ordinary income tax due on the withdrawal. But knowing the exceptions is vital.
What are some key ones?
You can avoid the penalty, though not necessarily the income tax, unless it's qualified Roth earnings or Roth principal if the distribution is used for certain things. Like a first-time home purchase, up to that $10 lifetime max per person.
Okay.
Or for medical insurance premiums if you've been unemployed for 12 consecutive weeks. For medical expenses that exceed a certain percentage of your adjusted gross income, AGI, if you become permanently disabled. For qualified higher education expenses for yourself, spouse, kids, or grandkids.
Right.
There's also one for expenses related to the adoption or birth of a child, up to $5,000 per event per parent. And exceptions for certain qualified natural disasters, up to $22,000. Or distributions due to death or terminal illness.
So quite a few situations where you can get the money out without the penalty, even if you still owe income tax on parts of it.
Exactly. Life happens, and sometimes you need access to that money. These rules can be a financial lifeline, saving you from a costly penalty tax.
And a popular strategy for long-term tax planning, especially for those who maybe anticipate being in a higher tax bracket in retirement, is doing a rollover from a traditional IRA to a Roth IRA, often called a Roth conversion.
Yes, a Roth conversion can be an incredibly powerful long-term tax strategy. When you transfer funds from a traditional IRA to a Roth IRA, the amount transferred is generally taxed as a distribution in the year of the conversion.
So I have to pay tax now?
Yes, any contributions you originally deducted and all the earnings in the traditional IRA are treated as taxable ordinary income in the year you convert.
Why would I want to do that then? Pay tax now?
The benefit is long-term. Even though you pay tax now, crucially, the 10% early withdrawal penalty does not apply to the conversion amount itself as long as it goes into the Roth within 60 days.
Okay, no penalty. And the upside?
The upside is that once the money is in the Roth IRA, all future growth and qualified distributions from that Roth in retirement will be completely tax-free. So you pay tax now, potentially at current rates, to get tax-free income later, possibly when rates are higher or you're in a higher bracket.
Got it. A strategic move. Finally, in this section on major financial decisions, let's touch on annuities. How does the tax exclusion work there?
An annuity is basically a contract, usually with an insurance company. You typically make a payment or payments, and in return, you receive regular payments back over time. Each payment you receive from an annuity is generally composed of two parts. A non-taxable part, which is considered a return of your original investment, and a taxable part, which represents the earnings or growth on your investment. Understanding that split is key.
So how do you figure out the split? Let's say it's a fixed period annuity, paying out for a set number of years.
For a fixed period annuity where payments are received over a set number of months or years, you calculate what's called an annuity exclusion ratio.
Okay. How?
You take your original investment, your cost basis, and divide it by the total expected value of the annuity. The expected value is simply the periodic payment amount multiplied by the total number of payments you're scheduled to receive.
Let's use Zoe's example. She paid $60,000 for an annuity that pays $750 a month for 120 months.
Right. So her expected total value is $750 times 120 months, which is $90,000. Her exclusion ratio is her investment, $60,000 divided by the expected value, $90,000. That comes out to 66.7%.
So 2/3 of each payment is tax-free.
Exactly. 66.7% of each $750 payment, which is about $500, is a non-taxable return of her original capital. The remaining 33.3%, roughly $250, is considered taxable earnings each month.
Okay. And for a life annuity where the payments are supposed to last for your lifetime, how do you calculate the expected value then?
Good question. For a life annuity, since the total number of payments is unknown, you can't use that same formula. Instead, you use IRS life expectancy tables.
Ah.
You divide your original investment by an IRS life expectancy factor, which is based on your age when the payments begin. This factor represents the average number of months someone your age is expected to receive payments.
Example. Let's use John. Invested $60,000, gets $600 a month for life starting at age 64. The IRS table gives a factor of 260 months.
Okay, so you divide his $60,000 investment by the 260-month factor. That gives you about $230.77. This amount of each $600 monthly payment is considered the non-taxable return of his investment.
And the rest is taxable.
Yes. The remaining $369.23, $600 minus $230.77 is taxable earnings each month.
What happens if John lives longer than the 260 months the IRS table predicted?
Once he has received payments for 260 months, he has fully recovered his $60,000 investment tax-free. Any additional payments he receives after that point are fully taxable.
And if he dies earlier, before getting his $60 back?
If he dies before recovering his full investment tax-free, the remaining unrecovered portion of his investment can generally be deducted on his final income tax return.
Interesting. So annuities can provide that steady income, and understanding that portion of your payments is tax-free is key to planning.
Definitely helps with managing retirement income and taxes.
Okay, now, let's turn our attention to the world of business, rentals, and other miscellaneous items where knowing the rules can dramatically impact your taxable income and, again, reveal even more opportunities for tax savings.
Right. For anyone operating as a sole proprietor, your net business income or loss, which you calculate on Schedule C of your Form 1040, is crucial.
And that income gets hit twice, right? Income tax and
self-employment tax, yes.
Yeah.
SE tax covers your Social Security and Medicare contributions. Gross income for a business includes the obvious cash received, but also the fair market value of property received for services, and even cancellation of debt related to the business.
And the expenses you can deduct here are absolutely essential for lowering that taxable income, aren't they?
They are incredibly powerful tools. Many common business expenses are deductible, and they significantly reduce your net taxable income, which in turn reduces both your income tax and your self-employment tax.
What are some major categories?
Well, you've got the cost of goods sold if you sell products. Salaries and commissions paid to others, not yourself. State and local business taxes. General office expenses, supplies, equipment rental, office rent.
What about driving for business?
Automobile expenses are deductible. You can track your actual costs, gas, repairs, depreciation, insurance, or use the simpler standard mileage rate, which the IRS updates annually. For 2023, it was 65.5 cents per mile.
Business meals.
Business meal expenses are typically 50% deductible, provided they meet certain criteria. You can also depreciate business assets like computers, machinery, furniture over time. Other common ones include employee benefit program costs, legal and professional services fees, and even bad debts, but usually only if your business uses the accrual method of accounting.
What about interest on business loans?
Interest expense on business loans is generally deductible, though there can be limitations, especially for larger businesses. But disallowed interest can often be carried forward to future years. There is an exception to the limitation for smaller businesses with average annual gross receipts under a certain threshold, around $29 million for 2023.
That self-employment tax, the 15.3% on top of income tax, can look like a big bite. Is there any relief there for sole proprietors baked into the system?
There is, and it's a significant tax-saving feature that many people don't fully appreciate. As you said, net business income is subject to that 15.3% self-employment tax, 12.4% Social Security up to an annual cap, plus 2.9% Medicare with no cap. This tax is actually calculated on 92.35% of your net self-employment earnings.
Okay. And the relief.
The crucial part for tax savings is that you get an adjustment to your income for one half of the SE tax you pay.
So I get to deduct half of the SE tax from my gross income.
Exactly. This self-employment tax adjustment directly lowers your overall adjusted gross income, which lowers your income tax. It's essentially the IRS's way of giving sole proprietors a deduction roughly equivalent to the employer's half of FICA taxes that regular employees don't pay directly.
Let's use Tyler's example. $20,000 net business income.
Okay, his SE tax would be calculated on 92.35% of that, so $18,470. The SE tax itself would be 15.3% of that, roughly $2,826. He gets to deduct half of that $2,826, which is $1,413, as an adjustment to income on his Form 1040.
That's a direct financial benefit that could easily be missed. Now, what if your passion project, maybe selling crafts online or writing articles, is arguably more of a hobby than a real business? The tax implications are very different, right? And this is where the IRS gets particular.
This raises a really important question for anyone with a side hustle or something they enjoy doing that also brings in some money. Are you genuinely running it as a business with the intent to make a profit, or is it fundamentally a hobby?
And why does that distinction matter so much?
The distinction is critical because it determines whether your expenses related to the activity can be deducted. If it's deemed a hobby, the bad news is your hobby expenses are not deductible at all.
Wow, not even up to the income.
No, not anymore. Tax reform changed that. You still have to report and pay tax on any revenue generated from the hobby, but you get zero deductions for the costs involved. If it's a business, however, you can deduct ordinary and necessary expenses, potentially creating a loss that could offset other income.
So how exactly does the IRS determine if something is truly engaged in for profit or just for pleasure? It seems like it could be a really gray area sometimes.
It definitely can be,
Yeah.
which is why they look at a whole set of factors. There are 9 key ones, often cited, among other facts and circumstances.
What kind of things do they look at?
They look at whether you conduct the activity in a business-like manner. Do you keep accurate books and records? Do you have separate bank accounts? Do you operate like a business?
Right.
They consider if you're an expert in the activity or if you actively seek expert advice. How much personal time and effort do you devote?
Mm.
Is it substantial? Do you rely on it for your livelihood?
Mm-hmm.
Is there an expectation that the assets used in the activity might appreciate in value? Have you successfully converted other unprofitable activities into profitable ones in the past? What's the history of income or losses? Are there sustained losses year after year beyond a reasonable startup phase?
Right.
Do you have occasional large profits that offset past losses? Crucially, do you have substantial income from other sources, like a regular job, that might suggest you don't need this activity to make a profit?
Yeah.
And finally, are there significant elements of personal pleasure or recreation involved?
That's a lot to consider. Is there any kind of shortcut or presumption?
Yes, there's a helpful presumption, though it's not definitive. If an activity shows a profit for 3 out of 5 consecutive years, or 2 out of 7 for activities mainly involving horses, it's generally presumed to be engaged in for profit.
And what does that mean?
It means the burden of proof shifts to the IRS to prove that you don't have a profit motive, which is harder for them to do. But if you don't meet that test, or if the IRS successfully challenges it and it's deemed a hobby, remember, you report all the income, but you deduct none of the expenses.
That's a critical distinction for anyone balancing a day job with a creative pursuit or side hustle. Okay, now let's talk about rental income or loss, and specifically this fascinating under 15-day rule you hear about sometimes.
Right. Most rental activity, like renting out a second home or an investment property, is reported on Schedule E of Form 1040. But there's a very special key tax saving related to renting out your personal residence for short periods.
The under 15-day rule.
Exactly.
Yeah.
If you rent out your personal residence, the place you live, for fewer than 15 days total during the entire year, the rental income you receive is completely excluded from your gross income. You don't report it anywhere.
Seriously. Completely tax-free.
Completely tax-free. This is a fantastic, lesser-known rule. So if you live near, say, a major golf tournament or a big festival, and you rent out your home for a week or maybe 2 weekends during the year,
Less than 15 days total.
and it's less than 15 days total, that income you collect can be completely tax-free.
That's incredible. Do I still get to deduct my regular home expenses like mortgage interest and property taxes?
Yes, you still deduct your qualified mortgage interest and real estate taxes as itemized deductions on Schedule A, just like you normally would. However, you cannot deduct any other expenses specifically related to that short rental period, like extra cleaning, utilities used by the renters, or depreciation. Those are considered personal expenses in this case.
But the income is tax-free. That's the main thing.
That's the huge benefit. If you're rented out for 15 or more days, then the rules change completely. You have to report the income, and you allocate expenses between personal and rental use with deductions limited. So that fewer than 15 days rule offers a unique, completely tax-free income stream for short-term rentals of your own home.
Good to know. Okay, moving into the realm of business structures, income or loss from flow-through business entities like partnerships, S corporations, and many LLCs. These can offer significant tax advantages, especially, I hear, with the S corp structure versus others.
That's right. With flow-through entities, the business itself generally doesn't pay income tax. Instead, the income, losses, deductions, and credits flow through directly to the owner's personal tax returns on Schedule K-1 and are taxed at their individual rates.
So the business income is only taxed once at the owner level.
Correct. This applies to various items like the business's operating income, but also separately stated items like rental income the business might have, interest, dividends, capital gains, charitable contributions made by the business, and guaranteed payments made to partners.
Okay, and what about when the owners actually take money out? Distributions.
This is a key point and often misunderstood. Distributions of cash or property to partners or S-corp shareholders are generally not taxable income to them when received.
Why?
Because the income is taxed to the owners when the entity earns it, regardless of whether or not it's actually distributed to them in cash at that time. So taking a distribution is usually just accessing money that's already been taxed or will be taxed to you via the K-1. It generally just reduces your basis in the partnership or S-corp.
Okay. But you mentioned the S corp having a particular advantage. What's the real kicker for self-employment tax here? The difference between partnerships, LLCs taxed as partnerships, and S corporations.
This is where it gets genuinely strategic, especially for active business owners. For partners in a partnership, or members of an LLC taxed as a partnership, guaranteed payments they receive for services provided to the partnership are considered self-employment income and are subject to that 15.3% SE tax.
Oh, okay.
Furthermore, a general partner's or an active LLC member's allocable share of the partnership's ordinary business income is also typically considered self-employment income, subject to SE tax.
So pretty much all the operating profit share is hit with SE tax for active partners members.
Generally, yes, if they're actively involved. However, for S corporation shareholders, the rules are different and often more favorable. A shareholder's allocable share of the S corporation's ordinary business income that flows through to them on their K-1 is not considered self-employment income, regardless of their level of involvement in the business.
Wait, so the profits themselves aren't subject to SE tax for an S corp owner?
Correct. Now, there's a caveat. The IRS requires that S-corp shareholders who provide services to the corporation must be paid a reasonable salary for those services. That salary is subject to regular payroll taxes, FICA and Medicare, paid partly by the corp, partly by the employee shareholder.
Okay, so you pay payroll tax on the salary part.
Right. But any remaining profit distributed to them as an owner's share, the distribution on top of the salary avoids that 15.3% self-employment tax or the payroll taxes.
Ah, I see. So you take a reasonable salary, pay payroll taxes on that, but the rest of the profit comes out as a distribution free of SE tax.
Exactly. This S-corporation structure can be a significant tax-saving move compared to a partnership or sole proprietorship, specifically for reducing your self-employment tax burden on your share of the business profits. It's a powerful incentive for many profitable small business owners to consider electing S-corp status.
Definitely something to discuss with a tax advisor. Okay, let's briefly cover a few other miscellaneous income types that are generally taxable, just for contrast, before we hit some more really crucial non-taxable gems that can add up.
Sounds good. Generally, prizes and awards like lottery winnings, game show prizes, are taxable at their fair market value. There's a very narrow exception if the winner is selected without any action on their part to enter, and they assign the award directly to a government unit or a charity before receiving it.
Okay, gambling.
Gambling winnings are always taxable income. You report the full amount you win. The flip side is that gambling losses are deductible, but only as an itemized deduction on Schedule A, and strictly limited to the amount of your reported gambling winnings for the year. You can't deduct net gambling losses.
Damages awards from lawsuits.
Damages awards are typically taxable if they're meant to replace lost profit, like in a business lawsuit, or if they are punitive damages, meant to punish the defendant. There are specific exceptions, especially for damages received on account of physical injury or physical sickness, which we'll get to.
And cancellation of debt, COD income, when a lender forgives a debt.
Generally, yes, that's taxable. If a lender cancels or forgives a debt you owe, that forgiven amount can be treated as taxable income to you. For example, if Mary owes the bank $80,000 on an unsecured business loan and settles it by paying only $30,000.
The bank forgives $50,000.
Right. That $50,000 forgiven is generally taxable COCE income to Mary. However, there are important exceptions, such as if the debt forgiveness occurs when the taxpayer is insolvent, their liabilities exceed their assets, or if it's related to certain qualified principal residence indebtedness. The rules vary. Or for certain student loan forgiveness programs, especially those covering discharges between 2021 and 2025 due to legislative changes.
Okay, lots of exceptions there too. Now, for some crucial non-taxable miscellaneous items, these are often hidden gems of exclusion that can truly make a difference in your overall financial picture. Let's start with life insurance.
Yes, this is a big one. Life insurance proceeds paid out because of the death of the insured person are generally excluded from the gross income of the beneficiary receiving them.
So, if I'm the beneficiary on a $1 million policy, I get the million tax-free.
Generally, yes. The death benefit itself is typically tax-free. However, there are a couple of caveats. If the insurance company holds the proceeds and pays them out over time with interest, that interest component of the payments is taxable.
Okay.
Also, accelerated death benefits payments received before death by someone who is terminally or chronically ill are typically non-taxable under certain conditions. There are also complex rules around company-owned life insurance, COI policies, where proceeds might be taxable unless specific notice, consent, and beneficiary rules were met. But for typical individual policies, the death benefit is excluded.
And what about that incredible inheritance you might receive? Or maybe a significant gift from a relative? Many people worry if those are taxed when they receive them.
This is another area with a lot of confusion. Gifts and inheritances themselves, the value of the property you receive, are generally non-taxable to you, the recipient. The gift tax or estate tax is potentially payable by the giver or the estate, not by the person receiving it.
So receiving the property itself is tax-free for me.
Correct. However, and this is a really key distinction, any income generated by that gifted or inherited property after you receive it is taxable to you.
For example.
For instance, if you inherit bonds, the inheritance of the bonds themselves isn't taxed to you, but any interest income those bonds pay out after you own them is taxable interest income to you. Or if you're gifted a rental property, receiving the property isn't income, but any rental income you collect from tenants after you own it is taxable rental income.
So while that incredible inheritance isn't taxed when you receive the asset, any dividends or rent or interest it generates for you afterward will be. That's a crucial distinction for financial planning.
Absolutely critical to understand.
That's a huge difference. What other miscellaneous items offer tax relief or are simply not counted as income?
Medicare benefits paid by Social Security are non-taxable. So is workers' compensation received for being unable to work due to a personal injury or sickness sustained on the job.
Okay.
Similarly, and this ties back to damages, compensatory damages received specifically as compensation for personal physical injury or physical sickness are generally excluded from gross income. Emotional distress damages might be excluded if related to a physical injury.
What about payments from my own accident insurance policy, the one I pay for?
Good point. If you paid all the premiums for your accident insurance policy, not your employer, then all payments you receive from that policy are generally excluded from your income, even if they exceed your actual medical costs. You paid for the coverage with after-tax dollars, so the benefits come out tax-free.
Okay. Now, for those working or considering working abroad, the Foreign Earned Income Exclusion, or FEIE, sounds like a significant tax break. How does that work?
It truly is a substantial benefit for U.S. citizens or residents working overseas.
Yeah.
Eligible taxpayers working abroad may exclude a large amount of their income earned from foreign sources from their U.S. gross income each year. The limit is indexed for inflation. For 2023, it was $120,000.
Wow. Exclude up to $120K? How do you qualify?
You have to meet specific requirements related to your time spent abroad. You must meet either the bona fide residence test, meaning you establish residency in a foreign country for an uninterrupted period that includes an entire taxable year,
Okay.
or the physical presence test. This requires you to be physically present in a foreign country or countries for at least 330 full days during any 12 consecutive month period.
So you really have to be living and working abroad substantially.
Yes. And this brings up an important planning point for anyone considering working abroad. While the income itself up to the limit is excluded, taking the exclusion can still impact the tax rate applied to your other non-excluded income.
How so?
The excluded foreign income is essentially added back in just for the purpose of calculating the tax rate on your remaining income. This means your non-excluded income could be pushed into higher tax brackets than it would be if you didn't have the foreign income at all. It's called stacking.
Ah, so the exclusion saves tax, but might increase the rate on other income. Good to know. Finally, let's talk about scholarships and fellowships, which are critical for students and their families. Are they taxable?
It depends. For degree-seeking students, undergraduate or graduate, scholarships and fellowship grants are generally excludable from income, but only up to the amounts actually spent on qualified educational expenses.
What counts as qualified expenses here?
That means tuition, mandatory fees, books, supplies, and equipment required for courses. Importantly, amounts used for other things, like room and board or travel, are not excludable and are considered taxable income.
Are there other conditions?
Yes, the exclusion generally applies only if no significant services, like teaching or research, are required as a condition for receiving the grant, and it's not primarily payment for past, present, or future services.
What about students who aren't seeking a degree?
For non-degree seeking students, scholarships and fellowships are generally fully taxable at their fair market value.
And tuition reductions for graduate assistants.
Qualified tuition reductions provided to graduate students engaged in teaching or research activities are generally not taxable if the reduction is in addition to reasonable compensation paid for their services. If the tuition reduction is their only form of compensation, then it is taxable.
So for students, carefully understanding these specific rules can be the difference between getting tax-free help with education costs and ending up with a hefty surprise tax bill on that aid.
Precisely. Tracking how the scholarship funds are used is key for degree-seeking students.
Okay, let's try and bring all of this together now. We've journeyed through really an incredible landscape of what constitutes gross income, but more importantly, all the fascinating and often overlooked ways the tax code actually provides for you to keep more of what you earn.
Yeah.
We've seen powerful employer-provided benefits, smart investment choices that yield tax-exempt income, crucial distinctions in how life events like divorce or inheritance are treated, unique exclusions for things like short-term home rentals or foreign income. There are just so many avenues for significant tax savings if you know where to look.
If we connect this to the bigger picture, I think it's really clear that effective tax planning isn't just about finding deductions at the end of the year. It's maybe more fundamentally about understanding what income is not taxable to begin with.
Right, starting from the beginning.
It's exactly. Having this proactive knowledge covering your workplace benefits, your investment decisions, how you handle major life events, that's key to truly managing and hopefully reducing your overall tax burden over the long run.
So what does all this mean for you personally listening right now? As you reflect on your own income streams and your financial situation, maybe consider, are you inadvertently including income on your return that could legitimately be tax-free?
Hmm.
Are there strategies from today's deep dive, maybe maximizing a fringe benefit you weren't fully utilizing, or looking into municipal bonds, or understanding the Roth IRA rules better that you can immediately explore and apply to potentially reduce your taxable burden going forward?
And this really raises an important final question for you to think about.
Mhm.
How might a deeper dive into your own personal income streams, applying these very principles we've discussed today, reveal even more tailored tax-saving opportunities you haven't yet discovered? It often comes down to just asking the right questions and knowing what possibilities exist.
Keep exploring, keep questioning, and definitely keep an eye out for those hidden tax advantages that are often hiding in plain sight within the tax code. Until next time, stay well informed.